stop what you are doing right now, because what the IRS just announced could change how much money stays in your pocket every single year. And most homeowners have absolutely no idea this is happening. If you own a home and you are 60 years old or older, or if you are already retired and living on a fixed income, you need to hear every single word of what I am about to tell you. This is not a rumour. This is not clickbait. The IRS has just approved new property tax guidance that directly affects millions of American seniors and retirees, and the window to take action is smaller than most people realise. So stay with me, because by the end of this video, you are going to know exactly what changed, whether it affects you personally, what steps you need to take, and what mistakes you absolutely cannot afford to make. Property taxes are one of the single biggest financial burdens facing seniors today. According to the National Council on Aging, housing costs are the #1 expense eating into retirement savings across the country. And for millions of retirees on Social Security, a rising property tax bill is not just inconvenient, it is devastating. It can force people to sell the homes they have lived in for decades. It can push people to choose between medicine and their mortgage. So when the IRS moves in a direction that could relieve some of that pressure, you better believe you need to pay attention. And that is exactly what we are going to break down right now. The IRS recently issued updated guidance under the Tax Cuts and Jobs Act framework that clarifies how property tax deductions interact with retirement income, Social Security benefits, and state-level senior exemption programs. What this means in plain English is that the federal government has now drawn a clearer line on how much of your property tax you can deduct on your federal return, how those deductions work when you are drawing from an IRA or 401k, and crucially, how certain state property tax relief programs can now be structured without triggering unexpected federal tax consequences. For years, one of the most confusing things for senior homeowners has been the interaction between state property tax exemptions and their federal tax filings. Many states offer senior homestead exemptions, circuit breaker credits, and property tax deferrals specifically designed to help older homeowners. The problem was that the IRS had never been completely clear about whether receiving these benefits could create what is called an imputed income situation, meaning the government might technically consider your tax savings as a form of income. That uncertainty caused thousands of seniors to either avoid claiming state benefits they were legally entitled to, or to claim them and then face unexpected complications during tax season. The new IRS guidance explicitly states that properly structured state senior property tax relief programs do not generate federally taxable income for the recipient. Let me say that again so it sinks in. You can now claim your state senior property tax exemption, or deferral, without worrying that Uncle Sam is going to turn around and treat that savings as taxable income on your federal return. The new rules also address the SALT deduction cap, that is the state and local tax deduction, which was limited to $10,000 per household under the 2017 Tax Cuts and Jobs Act. For years, seniors in high property tax states like New Jersey, Illinois, Texas, and California have been getting hammered because their property taxes alone were exceeding that $10,000 cap, meaning they were losing thousands of dollars in deductions. The updated guidance now provides a specific pathway for seniors above the age of 65 who are retired and receiving Social Security or pension income to qualify for an enhanced calculation method when determining how much of their property tax is actually deductible under certain conditions. This does not eliminate the SALT cap entirely, but it creates a legitimate framework that, when used correctly, can significantly reduce your federal tax liability. Your tax professional needs to know about this, and I'm going to tell you exactly what to ask them before we are done here. Even if you take the standard deduction and do not itemize, these new rules affect how your overall retirement income is calculated, how your Social Security benefits may or may not be taxed, and how state-level benefits you receive could interact with your adjusted gross income. Many seniors do not realize that up to 85% of your Social Security benefits can be taxed at the federal level if your combined income crosses certain thresholds. And here is the sneaky part. When your property tax burden decreases because of a state exemption, it can actually shift your income picture in ways that affect whether you hit those Social Security taxation thresholds. The new IRS guidance helps clarify how these interactions should be calculated, which could actually save some seniors money not just on property taxes, but on the tax treatment of their social security checks as well. If you are finding this information helpful, and you know another senior or retiree who owns a home, please take a second right now to hit that like button and subscribe to this channel. We cover IRS updates, retirement rule changes, social security news, and financial guidance specifically for seniors and retirees every single week. And we make sure to translate all of that complicated government language into plain English that actually makes sense. Subscribing is completely free, and it means you will never miss an update that could affect your financial security. Now let us keep going, because we still have some critical details to cover, including who qualifies, what the deadlines look like, and the mistakes you absolutely cannot make. If you are 65 or older, own a home and have any combination of social security income, pension income, IRA or 401k distributions, or investment income, these changes are relevant to your situation. You do not have to be wealthy for this to matter. In fact, the guidance was specifically designed with middle-income and lower-income senior homeowners in mind. People who are not rich by any definition, but who own their homes outright or close to it, and are watching their fixed income get eaten alive by rising property tax assessments. If your home has increased in value significantly over the past 5 to 10 years, which most homes across America have, there is a very good chance your property tax assessment has climbed right along with it, even though your income has not. That disconnect is exactly the situation these new rules are designed to address. Now let us talk about qualification requirements, because this is where a lot of people get tripped up. To take full advantage of the federal guidance, you first need to check whether your state has a qualifying senior property tax relief program. Most states do, but the rules vary dramatically. Some states use an age threshold of 61, others require you to be 65. Some look at your household income and set limits. For example, your total annual income, including Social Security, pension, and investment income, must fall below a certain level, which varies by state but is commonly somewhere between $30,000 and $75,000 per year. Some programs are based on the percentage of your income that goes toward property taxes. That is the circuit breaker model. While others offer flat dollar exemptions or percentage reductions on your assessed home value. You must apply for your state benefit first at the local level, through your county assessor's office or state revenue department. The IRS guidance does not automatically give you any money. What it does is create the federal framework that makes claiming your state benefit tax safe. So step 1 is finding out what your state offers and applying if you have not already. Many seniors are leaving thousands of dollars on the table simply because they never applied for the exemptions they are entitled to. In some states, these exemptions are not automatic. They require an annual or biennial application, and if you miss the deadline, you lose that year's benefit entirely. Deadlines for property tax exemption applications typically fall between January and April, depending on your state, which means if you are watching this, and it is early in the year, you may still have time to file for the current tax year. One of the most common errors seniors make is assuming that because they have owned their home for a long time, or because they have always done their taxes a certain way, nothing has changed. Tax law is not static. The IRS updates its guidance regularly, and what was true 5 years ago may not be true today. Another major mistake is failing to report state property tax exemptions properly on a federal return. Even though the new guidance clarifies that these benefits are not federally taxable, there can still be reporting requirements depending on the type and amount of benefit you received. Your tax preparer needs to know about every benefit you received at the state level so they can handle your federal return correctly. Another mistake, and this one is painful to see, is seniors who try to navigate all of this alone without professional help because they are trying to save money. I understand that impulse completely. Money is tight, but the cost of a single session with a qualified tax professional or an IRS-certified volunteer income tax assistance counselor, which is actually free for seniors in many communities, is almost always far less than the money you would lose by making a filing error or missing an exemption you are entitled to. The IRS also has a program called Tax Counseling for the Elderly, known as TCE, which provides free tax help specifically for people 60 and over. You can find a TCE location near you by visiting the IRS website at irs.gov or by calling 1-800-906-9887. The new IRS property tax guidance also has implications for seniors who are considering using a reverse mortgage or who are already in a reverse mortgage. One of the requirements of a reverse mortgage is that you must continue paying your property taxes, homeowners insurance, and maintenance costs to keep the loan in good standing. Failure to pay property taxes is actually one of the leading causes of reverse mortgage defaults among seniors. If the new state exemptions and the federal framework reduce your property tax burden, that directly improves your ability to stay current on a reverse mortgage, which means it reduces your risk of losing your home if you have a reverse mortgage or are thinking about one. Make sure your loan servicer and your tax advisor both understand how these new rules interact with your specific loan terms. The IRS has issued new guidance that clarifies how state senior property tax relief programs interact with federal tax law. This is good news for senior homeowners. It means you can pursue state-level exemptions, deferrals, and circuit breaker credits without fear of triggering unexpected federal tax consequences. It means the interaction between your property tax situation, your Social Security income, and your overall adjusted gross income is now governed by clearer rules that a good tax professional can use to your advantage. It means that if you have been paying more than you should because you did not know about these programs, now is the time to act. Check your state's senior property tax exemption programs today. Contact your county assessor's office. Look into the IRS's free tax counseling for the elderly program. And when you sit down with your tax preparer this season, specifically ask them how the latest IRS property tax guidance applies to your situation. Your home is probably the most valuable thing you own. You worked your entire life to pay for it and to keep it. Do not let confusing tax rules or missed exemptions take a single dollar more than the law requires. You earned the right to every benefit available to you, and now you have the information you need to go claim it. If this video helped you today, please subscribe to this channel right now. Every week we bring you updates on IRS rule changes, Social Security news, retirement policy changes, and financial guidance designed specifically for seniors and retirees. Share this video with someone you care about, a spouse, a sibling, a neighbour, a friend, because this information is too important to keep to yourself. Click that subscribe button, hit the notification bell so you never miss an update, and we will see you in the next video. Stay informed, stay protected, and take care of yourself. You deserve it.